Hi everybody, my name is Ben. Since topic is very hot because day after tomorrow, so I think on the 26th of January, some interest rates are going up, and Bank of Canada is everybody is expecting, so maybe their rates will go up, but not only a one time, maybe many times in next couple of years. So I have a little bit information to share with you guys, and I will not make a very long video, but I'll show you a few things where you can decide, and maybe if you need later on more information, so I can provide you guys more information. Since mortgage broker's role is to explain, then the client role is basically to decide. So I am a qualified mortgage agent, so that's why I'm sharing this information with you guys. But other than that, I'm working with Remax. I'm a real estate agent. It's kind of important to know both subjects, and since they're all related, financing and real estate trading. So anyhow, so that's why I'm trying to share some of the information. So my background part I have already explained you guys, and this is a schedule in 2022 from Bank of Canada. And this first meeting they have on Wednesday, January 26th. Then this is the other schedule, and this one is always you guys can just Google it also, and you will know what dates Bank of Canada are having these dates, and when they are thinking, all this, what's going to happen. And so the next is forecast is prime rate forecast is like I see. Then Bank of here, some of these banks are saying many hikes. Like Scotia Bank is thinking about 8 hikes by end of 2023, and the CIBC is thinking is 5, and TD is thinking 3. And generally each time the hike is they're thinking about 25 basis point. So but let's see what happened. And this is a little bit of information which is I can explain you all these things, and because all these mortgage our interest rates are all depending on these Canadian government bond rates and stuff. So when, at what time of the year, and these bond was yield at what price, and all those things. So I can explain you guys in detail. And this is another slide is beware, like when to get the mortgage. Like at the time of the application you will get a better rate, or you think you're going to have variable now, and down the road by like 18 months or 2 years or something you will switch back to fixed. And that does not sound good, because by the time bank will have, or you already they have trapped you, so they will not negotiate with you, they will not give you a better rate, they will give you the rate whatever they have. So there's a lot of things to discuss with your mortgage broker, mortgage agent, so they can guide you exactly when is the right time to fix up the mortgage rate and what rate you should. Then here is a level 2 spread. This is basically is when you're buying a variable rate mortgage, or you're getting the fixed. So what's the spread between these two? Because usually bank, when they give you a variable rate, they give you like a prime minus 0.50 minus 1, or minus 1.25. So that's a spread, and that has a good strategy. That's how bank give you the money. But then again, that's depend on the bonds, and how much of the bond price is, and how much is mortgage they give it to you. So this is very technical way of doing the calculations and all those things, and I can explain you guys need it. Otherwise you can ask your mortgage agent, mortgage broker. And inflation, like this is another thing, is like it depend what is this, you guys know what's happening on the food or gas, and all these prices and everything is going up. So where the inflation is, and where they're expecting it might go up and all down. And then a lot of unexpected things happening around the world, all this because COVID-19 and economies hurt, in every different sectors and stuff except pharma. Okay, I won't go there. Then this is there's some sort of calculations I will explain you, and like this is basically if you have 1.2 percent variable mortgage and a $1 million mortgage, and today's your payment is $3,307, and if you had that, then you were paying your money about $997 only, but $1,000 was going in your interest, and $2,310 was going in your principal amount. Then let's say if your fixed mortgage goes to 2.49, and your mortgage payment, instead of $3,307, it will be $3,939.39, so $3,939 at 2.49. And then instead of going 70% money in your principal, then your money will go only 45% into principal. Rest of the money will go all into interest. And next slide is basically, this is a basic small math I'm trying to explain you, but I will explain all as in detail as I said. So if you have a $1 million mortgage at we have figured out on the last our slide how much the interest rate was, 1.2 or something. So if 25 basis goes up, let's say next week or something, you will have to pay $250 every month extra on $1 million mortgage. So basically about $60 every week, your payment will increase with 25 basis point with $1 million mortgage. And this is another calculations, same with the $3,300, and will go into, right now is a mortgage, 70% is going in a principal, and if the mortgage goes to 2.49, and your payment will be $39.39, and the 45% of money will go into your principal. But then we have some calculations. If you consider like you're paying variable, but you're pretending is variable, but you're paying the fixed amount of money, and we will explain you that by paying about $600 or more a month, so where it will land you. So that is about on this slide. These are the information, and we'll explain. And this is understanding the fine print in fixed rate mortgages, and this is kind of, you're in jail, you're basically trapped. So you have to make your decision when you are taking the mortgage, and what interest rate you should, and if you should lock and go with the variable, and how you're going to manage that. If you do it now, you think you're going to change it later on to fixed mortgage, I don't think it's going to work that great. And there's a few other things are there. It's not necessary your variable and rate and mortgage, and fixed rate. In certain lenders, there's a few lenders, doesn't matter, the interest rate goes up. If your mortgage was $2,000 today, and your mortgage payment will stay like the same at $2,000, so you don't have to really be worried and about it, what's going to happen, because how they do it, and they will slow down your amortization period. But if your payment is 2,000, and you can still pay 2,000, there's a few lenders we work with them, and they do that. So, and definitely I hope and everybody will make maybe extra money, a lot of money in next year or two. And there's some point you guys can read, and what is this from the TD banks and stuff like. And I happen to also work with one of the Canada's private largest company mortgage outlet. So we have done over $1 billion in lending, and of course my office and team, and we are often on TV, on City TV, and we can guide you if you need any help and in these kind of days. So please don't hesitate to get in touch with me, and I can maybe give you advice, and if I won't able to do it myself, and I can recommend you to someone who will take care of you, because since this time is very busy and everybody's trying to close the deals, and before these rates goes up and stuff, so everybody want to tie up things. So anyhow, and see you guys next video, and I hope you will learn something out of it. Thank you.